Welcome to Think Smart with TMFG, the weekly podcast covering the financial topics that are newsworthy and relevant to everyday Canadians. Hosted by Senior Financial Advisor Mike Connon of the McClellan Financial Group of CI Asante Wealth Management Limited, here is today's episode.
Hi, welcome to Think Smart with TMFG. I'm Mike Connon. This is John Iaconetti, Financial Advisor with CI Asante Wealth Management Limited. So, John, a lot of news about Strait of Hormuz. So we keep on hearing about that.
Yeah.
It's so far away, right? It's a long distance from here, and it seems odd that something is on the other side of the world is affecting us as much as it is.
I agree with that. I mean, it does feel like it's really far away, but the reality is, like any other world economic event, it doesn't stay far away for long. It will be impacting our portfolios, client portfolios as well.
The thing about the world is the world's become, in the last 50 years, united. And how the economics work in the world now is the prices that get changed in one country spread across the entire globe very quickly. And when I mean very quickly, I mean instantaneously.
Yeah.
So that's a bit of what we're dealing with right now. Let's get down to some of the nitty gritty on this. The Strait of Hormuz, what is it and why is it important?
I mean, for our listeners listening today, you probably heard it all over the news, at least for the last month or so, ever since the war between the U.S. and Iran had really kicked off. Essentially, the Strait of Hormuz is just a narrow sea passage between Iran and the Arabian Peninsula. So this big connection is a hub for global shipping routes. Primarily, oil is going to be one of the most important things that does get shipped. So it's not just oil, actually. In that case, it's roughly about 19 to 20% of LNG trade, which passes through this route.
39% of the oil in the world goes through this strait. So I don't think people realize when they close this down and how much of an actual effect it is on the world. But think of 39% of the world's oil supply goes through this one little passage. But it was funny when you look at, they have all these different nice programs now that map things, right? You can go, there's one for airlines and you can see what airplanes are in the sky over you. There's another one for boats. And you can check the traffic in anywhere in the world in different sea passages. And if you looked at the Strait of Hormuz back, let's say 5 or 6 months ago, it had just tons of ships going through every day. It was like watching bees go into a hive when they were going through it. And we took a look at it a few days ago and it's just empty, right? So all that has really been taken apart. It's funny. I don't know how the licensing works. It's odd that they own that one piece of land. I keep on trying to figure out why. Because on the other side is Saudi Arabia is on the other side of it. But it seems to be that they have to go because it's such a narrow channel that runs right along Iran where they basically have the control over the passage that goes through it. So I guess you need a waterway that can handle that type of boat. They have to actually go through that one part of Iranian shipping lanes.
Yeah, exactly. And I mean, even if you think about it just simply from a supply and demand standpoint as well, if 40% of the world's oil is going to be impacted, everyone's going to feel the risk in some capacity. And we've had discussions on this in the past as well, where, I mean, Canada's not necessarily utilizing that oil that's getting shipped. A lot of that is going to be for Europe and for
none
Africa.
is for here. We're North America is self-sufficient. There was a question went out to Carney, and he's a very smart guy, so he gave a very detailed answer. But it was about why don't we just charge less for oil?
Yeah.
Right? And the reason is because when you go in, people get used to living in countries that aren't capital markets, right? We're in a market where our oil companies are not owned by the Canadian government. They're owned by entrepreneurs, oil companies that are privately owned. They're owned by foreign companies, and a lot of them are owned by China. There is a lot of oil companies in Canada owned by China. If they have an opportunity to charge more for a barrel of oil, they would be disappointing their shareholders and be held out to be kicked off the board very quickly if they did not raise their oil prices to match what the world demand rate is, right? So that's the reason why everyone blames the government. Government isn't really in control of oil prices. We've seen just recently the government cut a tax on gas prices to make things a little bit more palatable at this time, but they really can't have any impact on the price per gallon or per barrel of oil.
It's been out of their control, and now we have these rising oil prices. And that's where if we start thinking and shifting to how it impacts the average Canadian, inflation is the biggest concern, because not only in terms of gas for your car, heating for your home, but even a lot of the every regular day products that we purchase require oil in some way, shape, or form for manufacturing or even supplies. So with these rising oil prices, it's really going to act as that supply shock. So the lack of oil increases the costs around the economy, and that's going to put some really significant pressure towards inflation.
So you have direct and indirect. Well, let's start with direct. Obviously, when you go to fill up your car, you're going to see direct oil. It's pretty simple. And it shocks me when I look at the price of oil now, it's as we're doing this podcast, somewhere around $90 a barrel. Oil prices in 2008 were $150 a barrel.
Yeah.
So they've gone higher, right? They've been at that range. In 2020, they were negative $40 a barrel, actually, because there's so much oil, no one had anywhere to put it. So they do tend to fluctuate. And this is not, by far, this is almost a median of oil prices in the last decade. So it's not that far off where they would be. But again, it's the quick move that happens and the time it takes for people to adapt and adjust to them. And it's not the price right now, it's the future and where this is going to go, right? Because whenever you have this stop, it's going to create a shortage going out for the next, 4 to 6 months that we're going to be stuck with now because the shipping has stopped. So we're going to have to deal with that. That's direct. What are indirect costs?
Well, indirect costs could be through a lot of the manufacturers and companies that we purchase through. So a lot of companies might have to raise their costs because they're utilizing oil. A good example would even be airfare. Trying to think about trying to purchase a flight now. If you looked at trying to buy a flight now versus trying to buy a flight even a couple months ago, costs are going up dramatically just because a lot of the companies that we're utilizing are having to pay even more for their energy costs. So everything all around us is going to be there. The grocery stores, shipping in fruits and vegetables.
Right across the board. And yes, you're right now seeing Europe, they're already starting to cancel flights just because they know there's going to be a shortage. Airplane fuel is tougher to get. They're going to have a shortage in Europe. And there's other things we don't realize that are made of oil that are. There's a lot of petroleum-based plastics that are based on the heavy oil. And that price goes up with that too. So even the raw material of a lot of the products we use are going to change too.
So we are starting to see it now, probably starting to see it a little bit more in the grocery stores and a little bit more just in terms of everyday regular living. So if we are going to start to experience that rising inflation, we actually had a relatively recent history of this, even coming out of COVID when inflation was on the rise. And usually when that's the case and inflation starts to come on the rise, what happens next? Interest rates are usually not too far away and they tend to follow.
The problem is when you have a shock to the system like this, the interest rate adjustments don't really work the same way. To give you a quick idea, when there's lots of money in the system, people start to overspend. And what the government does is say, well, if we raise interest rates, people have less money to spend. Essentially, we're going to shorten the money supply, and it's going to be more expensive for people to borrow money. We're going to really shorten the money supply, which should bring down the cost of all these goods because people are going to have less money chasing after the goods. So usually you're controlling the money supply. The problem that happens with this oil is we've stopped the supply. It's not the money. The demand is still there. We've stopped the supply for the demand. So when you do that, interest rates aren't going to have any effect on that because essentially the demand is there for oil. The shortage is there. So again, it's going to continue to go and keep that part of the inflation moving. So you can try to affect other parts of inflation. But again, when you do that, you may have an economy you shouldn't be slowing down at this time because the other parts should still be moving. This is when you get a lot of the fears when you hear people talking about things like stagflation in the past. And stagflation is one of those terms from the 70s. It's when you have higher costs, but you don't have higher income to offset those costs. And you get a series of what we call stagflation. It's usually a nightmare from the financial side of things because when you have rising costs and no more money, people have to continually, their world shrinks around them without them doing anything. So that becomes a real economic problem. So we're hoping this stuff gets it sorted out so we can avoid those type of real economic uncertainties going on.
That's in terms of the economic side of things, but the markets and the portfolios are a bit kind of related, but they're kind of not. So now we're starting to see within the market and the portfolios just an absolute yo-yo of a back and forth in terms of positive and negative markets in the last little bit. And from our standpoint, it deals a ton with investor behavior.
Yeah.
So there's a lot of people now that don't know how to best navigate the situation. What have you been telling your clients, Mike? Like, what would be the best way to navigate this situation?
Well, the best way, no knee-jerk reactions. High oil price, it's funny, high oil prices are actually linked with better stock markets when you look over, because historically speaking, when it's usually not a shortage thing, it's usually a demand thing. And usually demand is driving up the price of oil, and demand is because the economy is really working. So when you look historically speaking, high oil prices are not usually a terrible thing for the marketplace. But this is a really different situation than we've had in the past. So what you have to do is continue to keep focused into the future, looking out for the long term rather than all of the negativity going on over this year. Or, we have the whole politics situation in the US. It's definitely affected everyone. But hopefully, if you look down in the future, it won't always be as, let's say, controversial as it is right now. And when you're investing, you're not investing for the next 6 months, you're investing for 10, 20 years down the road. So you have to keep your eye focused.
I mean, we're always trying to navigate through the short-term noise that is the markets. There's always some sort of reason for market volatility, but we always focus back on the financial plan. And the reality is for a lot of people, the real thing that might be impacting your financial plan right now is the short-term increase in costs, just in terms of living. So that's why we always recommend speak with your advisor, have a quick look at the budget and assess if things are in a still comfortable position for you. But at the end of the day, the markets are going to be volatile, inflation is going to be volatile, and you just need to make sure you're staying on top of it and continue to project out for the future.
I've yet to ever see a time when inflation is not a factor in what we do. So
exactly.
There's always different reasons for the factor, but it truly always is a factor. So that's something we just have to go and deal with. It's part of being in the financial world. Mm-hmm. And to be honest, not even being in our jobs in the financial, it's part of being a person.
Yes.
You're going to have to deal with inflation. Costs are going to go up over time. So just to conclude this episode, the big takeaway, these global events don't stay in the headlines. They definitely work their way through the entire system. So as we go through this, we're now experiencing what's actually changing from this headline that we read a few weeks ago and how it's actually having a real life effect on us.
That's why it's less about reacting and more about having a plan that already accounts for this type of uncertainty. So remember, if you want to learn more about TMFG, check out the show notes for details on how to connect with us, or you can reach us at 905-771-5200 or visit our website at tmfg.ca. If you got questions, feel free to leave a comment on the podcast website. We'll gladly cover them in any future episode. There's been a lot of experience that our office has had with clients during times of uncertainty. I mean, if you think back to more recent history, COVID and having to navigate all that, it's a very difficult time for people. So I completely understand the need for concern, but it's an even more need for speaking with a professional that knows how to navigate it.
COVID set our bar for weird things can happen. Yeah. So everything after that seems pretty simple to navigate through.
Exactly.
That brings us on the end of another episode of Think Smart with TMFG. Thank you very much for listening.
You've been listening to Think Smart with TMFG with Mike Connon of the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube Music, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description. This program was prepared by Michael Connon, Senior Financial Advisor with CI Asante Wealth Management Limited. This is not an official program of CI Asante Wealth Management Limited, and the statements and opinions expressed during this podcast are not necessarily those of CI Asante Wealth Management Limited. CI Asante Wealth Management Limited is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. This show is intended for general information only and may not apply to all listeners or investors. Please obtain professional financial advice by contacting us at 905-771-5200 or visit tmfg.ca to discuss your personal circumstances before acting on any information presented.